once again, everyone. My name is Lori Page, and I'm coming to you from the advisory team here at Sound Wealth Management. Market volatility is nothing that we haven't seen before. Remembering just 2 years ago, in March of 2020, we saw 3 record-setting market drops for the Dow on March 9th, 12th, and 16th, each of over 2,000 points. What we forget, though, is that at the time of writing this, even with the volatility that we're experiencing in the time of crisis in the Ukraine, that the Dow is currently sitting more than 7,200 points higher than it was prior to beginning its 2020 freefall at the beginning of the pandemic. During times of stress, it's hard to remember that these things are not permanent and that there are actions we can take to help us weather the storm. As we continue our efforts to stay informed of economic conditions and provide you with relevant information, ideas, and strategies, in the last 48 hours, we've been on conference calls with leading economists from JP Morgan, T. Rowe Price, and State Street Global Advisors. By way of an update to last week's video, I'd like to share with you some key themes and takeaways from these calls to perhaps shed some light on the status of the U.S. economy and the potential impact of the Russia-Ukraine conflict, as well as some ideas for investment strategies to potentially help you position your own portfolio moving throughout the rest of this year. So first, let's take a look at the U.S. economy prior to the Russian invasion of Ukraine. While we're waiting for additional reports to come out later this week, recent reports and expectations have been favorable and show that the U.S. is recovering quickly. We're experiencing low unemployment, high wage growth, and supply chains that are improving, albeit slowly. So where are we now? Uncertainty is the key term right now. Russian markets are halted. Russian capital controls may trigger a series of defaults in the debt market. We have likely hit the peak of Western sanctions, but not the peak of the effect of the Western sanctions, and this is going to take some time to work through. Russia is invaded with considerable military forces at its disposal. The Ukraine continues to resist with considerably less military arsenal than Russia. There are 3 predominant possible outcomes from this situation at this point. 1, Russia takes over Kiev and says that they've won. 2, which is the least likely scenario, they sustain such losses that they give up and withdraw. And 3, a prolonged conflict continues. As often happens during periods of market volatility, many people have begun throwing around the word recession. And while we have dipped a toe into correction territory, we're not quite there yet. So what would make a recession more probable? First, while a recession remains a possibility, current economic conditions make it highly unlikely for this year. And if it happens, it'll most likely be very short-lived. According to JP Morgan's chief global strategist, Dr. David Kelly, the recipe for a recession must include 3 things. 1, full employment. 2, a policy mistake. For example, the Fed going too easy too long. And 3, a shot to the economy. For example, a major cyber attack. However, while a recession is unlikely, we must recognize that the current situation is highly unstable. For that reason, it's unwise to try to time this tactically. Instead, have a structured way to deal with this by broadly diversifying your assets. So let's look at some of the economic impacts of Russian invasion of the Ukraine. This conflict brings to light the importance of both energy independence and the need for allied energy sources, as Russia implies 10% of global crude oil. So we expect the U.S. to begin to ramp up oil production and potentially for Iran to come back online as well. Domestically, the total U.S. energy spend for all types of energy is only 4.3% of our economy. So while inconvenient, the hit to U.S. consumers for increased energy prices won't be detrimental. However, it could potentially cause a hit to consumer confidence, but likely not a substantial one. Businesses tend to be more cautious than end consumers in America. Expect greater energy spending, particularly on alternatives and particularly in Europe. We expect a reconciliation bill to pass sometime this year and expect it to include some items from Build Back Better, things like energy funding as well as some potential fiscal stimulus. We also expect this reconciliation to include some aid for the Ukraine. We expect to see some action from the Fed this year as well, and the Fed will start tightening, but we expect the approach to be steady and measured. We expect to see a rate hike here in March, as well as a total of 3 to 5 yet this year, but don't expect them to be particularly large, something more like in the realm of 25 basis points or so. And we also expect that the European Central Bank will be even more cautious than the US Fed. So what this means for the investor. Right now, the markets want two things. They want uncertainty to dissipate, and they want knowledge that this conflict is localized, so no systemic spillover. We expect that supply chains will normalize this year, but this conflict, that's going to delay it. Where we are a month from now is going to be a very important question to set the pace for the rest of 22, and especially in Europe. Expect to see more growth-oriented fiscal policy throughout the globe. Fixed income volatility is largely contained right now to the securities of the impacted areas and some of the markets that are immediately adjacent to them. And people are starting to look for income, and they're making a flight to some of the safe haven sources such as US Treasuries. Commodities futures suggest that high prices will begin to ease over the next 6 months or so, but not right away. Hotter than normal inflation will likely continue at least through the summer. And for those that are seeking income, we're going to need to start to get a little more creative in the fixed income space, looking to things like emerging market securities, some high yield, some alternative, as well as paying more attention to the equity markets, looking to things like preferreds, potentially even some options and derivatives. And for those of you that like to invest in the equities, I'm going to leave you with a few equity strategies as well. In the short term, we like value positions, particularly things in the consumer cyclical arena. And then towards the end of the year, we're going to like a shift towards industrials and financials. And the catalyst for this shift is going to be a resolution in the Russia-Ukraine story. Long term, however, we like the growth story still with particularly tech-focused companies, as well as a shift towards energy independence with emphasis on ESG. Now, I know there's a lot of questions out there too about crypto, particularly with this conflict. And this conflict is going to have a significant impact on crypto because once these financial sanctions are imposed, it becomes the only outlet for sanctioned countries because crypto is highly unregulated. And this has now been realized and noted by the regulators, and will likely spur them to take swift and aggressive action to begin to regulate those cryptocurrencies. Because not all investment products and strategies are appropriate for all investors, it's advisable to have a conversation with your advisor on what strategies are most appropriate for your specific needs and goals. To have this conversation with the advisory team here at Sound Wealth Management, please reach out to us at 941-932-4822 or schedule your no obligation consultation online at www.soundwealth.net, where Sound Wealth Management is more than just our name. We look forward to working with you now and in the future.